All right, thank you very much. I appreciate your time. Okay, so I'll just touch on our full year results for FY19 just quickly. We had a really solid year. EBITDA was $114 million, up 40%. EBIT up 50% to 125. We continue to build on our margins. The EBITDA margin went from 40 to 46%, and operating EBIT margin up to 27%. So the business continues to build in size, and also I think the quality of our earnings and our margins as we continue to focus on cost and increase our utilisation and push up our rates. So very, very pleasing result. I think net leverage just dropped below 2 times, which is great for us on our journey to deleveraging, given the business was about 7.5 times levered when we started off this thing in about 2015. So very happy with that. Very pleasing. We spent some CapEx this year, some growth CapEx, but this business generated $90 million of operating free cash, and we'll continue to generate that sort of free cash moving forward. There's no sort of growth CapEx plan for the next couple of years, and maintenance CapEx is pretty much in line with depreciation. So year on year, we're expecting this sort of free cash flow, which gives us optionality about further debt reduction, about really getting that leverage down to 1 times, which we're targeting by the end of FY21, and rewarding our investors with a dividend over time as we generate that sort of cash. Our return on capital at 21% is something that we're really proud of. Previous Emeco peaks during mining cycles has been around 11% the return on capital. So to get a 21% return on capital following 20 last year is particularly satisfying, and it really is a reflection of how we run the business these days. We've developed very strong engineering capability through the acquisition of a business called Force, which has got 7 strategically located workshops. We rebuild our equipment, we rebuild our own components with the extended life of our equipment. It certainly preserves a lot of CapEx, and we work our gear a lot harder. Our ability to sweat our assets whilst maintaining very strong performance, both in maintenance and reliability, has led to that sort of return on capital, which to me is all about sustainability of our business. The workshop activity, not only do we rebuild our own equipment, but we also rebuild our customers' equipment. We've got some excellent customers that entrust us with their fleet, and the activity that went through our workshop increased by 56% the last 12 months, which is satisfying. And there's plenty of scope for us to improve that further as we bring our workshops on the East Coast online to do retail works. Operating utilisation is at 64%. It's actually 90%, I think, or high 80s, 90 in regard to gross utilisation, equipment on rent or off rent. 64 is a measure we have of how hard the equipment's working. It can work a fair bit harder. I've got some slides to show you that show where we can take that. This is a bit of a busy slide, so bear with me here. I just wanted to tell a bit of a story of where Emeco has come from, where we're at the moment, and the foundation that we've created for future growth. Just a quick history of the last 4 years. We've increased our EBITDA by 5 times. Our margins have tripled. I think we're particularly good at managing costs. It's a daily focus for us, and we're very, very disciplined. Our workshops, we've got 7 of them around the business, around the country now, and we do retail work as well as rebuilding our own fleet. We've developed EOS technology that we're very proud of, that not only helps us with our asset management and monitoring the components in our equipment, helps our customers achieve greater productivity from that equipment. So very proud of that development. I mentioned about the 20% ROC, which is well above our WACC, which to us is all about sustainability, and getting that balance sheet below 2 times from 7.5 times on its way down to our target of 1 times is all about sustainability of our businesses as well. We're excited about the cash flow, and we have in the last 12 months invested in some growth assets, which we've put to work, and we're very proud of that as well. We put $90 million worth of growth CapEx into the business, so that was our plan for the back half of FY19, and we sourced a heap of equipment from around the world. bought it in, rebuilt it for our Force workshops and put it out to work, and that's gone really well for us. I think we came in at 85. So that's positioned the fleet particularly well, and that'll be it for us for growth capex for at least the next couple of years as we get that target deleverage down to 1 times. So where does all that work that we've done over the last 4 years position us? I think it gives us a great foundation for future growth of this business. We've got a young fleet of in-demand mining equipment, around 800 pieces based all around Australia. It's not specific to any commodity. Our fleet can move throughout the regions, throughout the commodities. It's a very, very well-tailored fleet for the market's demand. We're very disciplined in the way that we acquire and run our fleet. We don't acquire fleet for specific projects. We acquire fleet for the next 5 to 10 years of where we see the market going. We have the ability to guarantee our machine availability and reliability, and we provide that to our customers. I look at our value to our customers being capex risk management around the equipment, but also we guarantee how many equipment hours we deliver on a monthly basis to our customers, which I think is very valuable. We work extremely hard to be the lowest cost provider of equipment, and there's some slides supporting that. The back end of the back there. Workforce, 543 people with some surge capacity on top of that. It's a big workforce. It's a workforce primarily of skilled tradespeople, which is really important for us in regard to ensuring our own equipment achieves the highest standards, but also rebuilding our customers' equipment. So it's a tough market, but I think our team do a particularly good job of attracting and retaining good people. We'd be well below the market sort of turnover. It's a really solid workforce. Asset management is something that we spend a lot of time on and have really developed over the last few years. It's very much the driver of that strong return on capital. We have a centralised planning team that sits in Brisbane. We manage the health out of all the equipment, and not just the equipment. We consider each component within the equipment as part of our planning process. So, a truck may have 15 major components that we focus on. So each of those components gets planned. There's cost justification for each time we replace them, and our planning process is very complex and very strong. I mentioned the workshops all around Australia, the EOS. We have very strong customers and long-standing relationships with our customers. That's absolutely a key part of our business. We are by far the largest player in our industry, but it's really important that we have people from each of the specific regions representing our business. We don't want to come across as over corporate or aloof from our customers. So we have people that grow up in Mackay or grow up in Queensland focus on our Queensland business. Same with New South Wales, same with WA. They're very, very close and well connected to the industry. And I mentioned the strong operating cash flow year on year in the next few years, which gives us a lot of optionality. So, as we talk about how we use that platform to create growth moving forward, and we do believe that there's plenty of growth capability left in this business. Rental rates and utilisation, there's still room for that. We keep pushing up rates. We believe there is a supply-demand imbalance for equipment in the industry, and we've got some supporting documentation, and we believe that supply-demand imbalance will tighten even further, which gives us, along with all our capabilities, real opportunity to further increase utilisation and rates and get growth from our fleet. The workshops, there's a lot more work we can do in our workshops. We can run them day and night shift. Most of them are day shift at the moment, and our East Coast workshops are predominantly internal, so we can do retail work through that. It's providing additional services. I find that really interesting. As I mentioned, we've got 800 pieces of equipment placed with strong customer relationships around the country. We should be able to build on that. We should be able to provide our maintenance services, not just to our fleet, but to our customers' fleet. We do it in our workshops. There's no reason we can't take that onto our customers' sites. There's no reason we can't take on more responsibility for maintenance of our fleet and really grow our earnings there. So excited about how we can build on that capability and that footprint that we have. From a capital management perspective, we've got expensive debt in place. We've got a non-call period that falls away in April next year. Our debt goes through to April 22. but we can either refinance or start paying down our debt with that free cash flow as of April next year. And for us, leverage is one measure, but actual gross debt is another measure as well. So really focused on improving the capital structure of this business and setting itself up for sustainability. Discipline is the key word for us in the way we run our business, and I think it's the key difference between Emeco of now and the business that Dale and I have built versus Emeco of previous eras. We are disciplined. You will see us being disciplined in the way we manage our capex and the way we manage our kit moving forward, and you will see strong operating cash flow that will be used to deleverage the business and also give us optionality in the future years. So, just to touch on what this presentation is all about, is we've worked hard, we've set a platform, we believe we've got this business at the starting line now, and we can achieve significant growth from this point forward. And I just wanted to touch on the market conditions and the dynamics and supply-demand of equipment that gives us confidence about growth. So this graph here represents total material movement. We supply earth-moving equipment to the industry. We predominantly move overburden. So for us, it's not so much how much gold or iron ore is going out, it's how much material movement. And what this graph here represents is that the forecast material movement continues to increase. We see that on a daily basis. We see that with our existing customers asking for more equipment as their strip ratios increase, and it places us well to work our equipment harder. This graph we've used before, but I think it's really interesting. It's a little bit busy, but what it does is it represents on the y-axis annual production of iron ore, coal, etc., the bulks, and on the x-axis the amount of equipment that's come into the country over the years. And what you see through this period of 2003 to roughly 2008, around the financial crisis, there is that you see a steady sort of increase in production tonnes, and it's fairly steady gradient of the amount of equipment that's coming into the country to support that growth. It stalls a bit in the financial crisis, as you would expect, and in that period 2010 through to about 2013, we saw an absolute wave of equipment coming to the country. The capex spent during that period was quite exceptional, and there was a massive amount of surplus capacity. And that's where you saw, the commodity prices going down. You saw a lot of mining services companies, including us, go through some really tough times. And what we've seen since is that our mining customers and the industry has become far more disciplined with capex. They're getting a lot more out of equipment than they used to. They're doing the same as us. They're rebuilding their equipment. Utilisation's increased, and it's really used up all of that surplus capacity. And if you look at the gradient of this line here, new equipment into the country is absolutely stalled. It places us in a really good position in regard to the amount of material movement versus the amount of equipment in country. And this represents the same sort of thing, really, that in that 2012, 13, 14 period, when there was a surplus of equipment in the industry, utilisation of that equipment dropped quite significantly, and that spare capacity has basically been used up now, as you can see by the strong utilisation across the mining sector. And if we look at the forecast equipment imports, and we'll look historically, overall equipment that's come into that country through the period, it is increasing over time, but what this graph represents here is the majority of that fleet that's forecast to come into the country is purely to replace existing equipment as it wears out. There's some growth assets there, but most of the equipment will replace assets as it reaches the end of its life, which again shows that we're not forecasting a change in the supply-demand dynamics that we're experiencing now. In fact, we expect it to tighten. If you look at our fleet, we have a very large fleet of equipment, 800 pieces placed all around Australia. I think it's 87% Caterpillar, so it's largely a Cat fleet of equipment. It's a very well configured fleet. I mean, we're always looking at optimising our fleet configuration how many diggers we need, how many trucks, all different sizes, and a lot of work goes into it. We're never satisfied with it, but within my time working for Emeco, I think it's as well configured as I've seen for market demand, and not just for specific project demand, but from going to project A to B to C to D, which is ultimately our business model. The scale of that fleet, many people realise that, but that's actually not our competitors. That's the market. That's major miners, contractors. That's the entire market. You know, as far as fleet by numbers, we really are a very, very large provider of earth-moving equipment. And it's a young fleet too. This graph here represents the equipment life in thousands of hours, and where you see this histogram represents the Emeco fleet. There's a hell of a lot of life left in this fleet compared to the industry average, and where people are running equipment out to. So, you know, I suppose the message here is there's lots of life in our equipment. When I tell you there's going to be no growth capex for the next couple of years, or replacement capex is pretty much in line with depreciation, that's why, because our fleet's relatively young, very young compared to the industry, and it's got a hell of a lot of life left in front of it. I personally found this slide very, very interesting when we were working on it. But, so what this shows is where Emeco's operating utilisation is at the moment at 64%. I think this will naturally kick up in the next couple of years towards FY21 up into the 70s. But what it shows is the industry average of the way that our customers, the miners, are using equipment is really very, very strong. And this is trying to provide an apples with apples approach. I think our great challenge and the great upside in our business is how do you position this fleet? You know, how we actually position this fleet away from being surge capacity or additional fleet or capex risk management for our customers, and as the equipment market tightens, push this equipment more into their sort of key production units. That's where the real upside of this business is, and I'm personally very excited about that. I've spoken to most people, investors over the years, and saying, look, you know, we're targeting and pushing this thing up to around the 70s, and that's where it's been historically. I actually think there's room to take that a hell of a lot further and push it right up into sort of this area here in regard to operating utilisation. So, very excited by that. Lots and lots of work to do. It's to keep working our model, working our projects, placing our equipment with our customers, and supporting it very, very well so we can get that utilisation right up. Another thing that we constantly focus on, we have daily calls with all of our regional managers, is cost. We understand it's a cyclic business, and we understand how important it is to be not only the highest quality, but the lowest cost provider in the industry. Now, this is where we are with two pieces of equipment that is core to our fleet, the D11 dozer and the CAT 789 190-tonne truck. You know, that's come down a long way from where Emeco was, and where we sit in the industry, you know, from a cost perspective, gives us a real strategic advantage compared to our competitors, and allows us to add a lot of value to our customers. So again, that to me is all about sustainability, and we focus, we're very disciplined in our cost focus. And this is shown also in the way that we manage our components. You know, the life we get from our components, we rebuild our own componentry for our force workshops, and this histogram here represents in the industry where we sit in our ability to extend the component lives and the life we get out of our components and equipment. I mean, running earth-moving equipment is all about managing components. It's how well you can rebuild those components for, how cost-effective you can do that, and what life you get out of your components. We've invested a hell of a lot of resources and energy and funds into our asset planning, the sensing on board, the measurement of our components, the rebuild and quality of our components, and it's particularly pleasing to see where we sit there, and we'll keep pushing to be you know, industry best practice. So that's it. Thanks for your time. I've recently been around doing investor calls and road shows on the results. I didn't want to touch on that too much today, just a quick overview. What I was hoping to show you here is that we are confident we can get more growth out of this fleet. It's a large fleet compared to the industry. It's well positioned. We manage it well. It's very low on the cost curve, but very high from a quality perspective, and we work hard with our customers to to help them add value to their projects with this fleet. So thank you for your time.